An investment in dividend stocks can either leave you with stocks that will make you lose tons of money, or with stocks that will help you make passive income without you lifting a finger. So if you would like to prevent grave losses in the future, here are 5 steps that can help you analyze that dividend stocks before investing in it. Step 1 is understanding the company's business. You have to understand the company's business model, their growth strategy, and their dividend policy if they have one. Understanding a business model is simply understanding how that business makes money, while understanding their growth strategy, on the other hand, is seeing how this company plans to increase its revenue and earnings, and by how much. GPC's growth strategy is a perfect example. GPC happens to be a dividend paying company, and it stands for Genuine Parts Company. They come right out to say that their goals are to increase revenues 6 to 8% annually and to increase earnings 7 to 10% annually. Then they even go further to explain how exactly they plan to go about this. Dividend policy, on the other hand, sets the parameters for which dividends will be given to shareholders. It covers the type of dividend distribution, its frequency, and timing. Dividend policy is very important because it will determine how much dividend you get and when you get it. And of course, this is very important for investors who plan to live off their dividends. Step number 2, evaluate dividend safety. You do this by calculating the dividend payout ratio using earnings, evaluating the company's debt levels and credit ratings, and looking at the forward dividend yield. For a dividend payout ratio using earnings, a lower dividend payout percentage is a good sign. It shows that the company can maintain or even increase its dividend payouts during tough times. Acceptable dividend payout ratio varies by industry, so you can simply search on a dividend payout ratio for a particular industry you're interested in, and I'm sure you'll find something useful on Google. Credit ratings are provided by big rating companies such as Moody's and S&P. A AAA credit rating is the highest credit rating by S&P, and very few companies have a AAA credit rating. Microsoft, for example, has a AAA credit rating. What you can see right now is an image of the credit rating levels from low to high credit risk, and of course, the lower the credit risk, the safer the dividend stocks. Furthermore, to analyze a company's debt level, you use their debt to equity ratio. Trust me, what you don't want is for your stocks to be loaded with debt. A large amount of debt can jeopardize consistent dividend payments, especially during tough times or economical crises. So you can look for a debt to equity ratio of 1 or less than 1. If you find a company whose debt equity ratio is more than 1, it doesn't necessarily mean that the company is a bad choice. What you just have to do is to further investigate on why this is so. As for dividend yield, a yield is the company's current annual dividend payment divided by the current share price. It is expressed as a percentage as well. Experts say that dividend yields between 2 to 4% are safe, but some also go for ranges between 3 and 5%. What you should know if a company's dividend yield is far below 2 or 3% is that it can indicate that the company does not provide enough current income just yet. And if it's much higher than 4 or 5%, it can indicate that the company might not have a significant increase in its dividend in the coming future. Or worst case scenario, the dividend can even be reduced in the future. At the end of the day, feel free to set your own dividend yield requirements. Step number 3, likes are free. Experts say that when you like this video, you have a higher chance of making money through dividend stocks. Don't look at me, I'm just preaching the gospel. Step number 4 is calculate the historical dividend growth rate of the company. History may not repeat itself again, but it definitely is a good starting point for judging the future. If a company doesn't have a good track record of dividend growth, why would the future be any different? First off, how many years in a row has a company increased its dividend? A long track record of dividend growth is definitely a good sign. There are companies who have increased their dividend on a yearly basis for 10, 25 to even 50 years. So you can review the annual dividend growth rate of a company for the past 1, 3, 7 to 10 years as far back as you want. This will give you a solid idea of that company's dividend growth rate. Some people prefer a dividend growth rate of 5 to 8% on an annual basis. The lower the current dividend yield, the higher the dividend growth rate required. Higher dividend growth rate is all well and good as long as the company has the earnings growth to support it. With your preferable growth rate, you can then make a growth forecast for your dividend portfolio. If you prefer a dividend growth rate of 5 to 8% annually, you can then forecast a dividend growth of that range on an annual basis. Step 5. Review the company's historical revenue trend. Determine if the company's business model is healthy by looking at the last few years of its annual revenues. Dividend stocks with growing dividends have growing earnings, and growing earnings partly come from growing revenues. If the company's revenue is in decline, you can then find out what their plan is on turning that around. Step number 6, review the company's valuation. Whether you choose to invest in dividend stocks or companies who do not offer dividends, it is very important for you to actually assess the value of the company you are about to invest in. One way to run a valuation check on that stock is by taking a look at the PE ratio, the price to earnings ratio. A PE ratio is calculated by dividing the current stock price by the earnings per share of a company. This number is used by fundamental investors to know the relative value of a particular company in comparison to its peers, to know if the company is either undervalued or overvalued. For example, let's say a company X PE ratio is 20. That means if you decide to buy the share of the company X, it translates that you're willing to pay $20 for $1 of the company's earnings at the current share price. Is this a bad or a good thing? You compare the company's value to that of its peers. A high PE ratio can mean that a company is overvalued, and a low PE ratio can mean that a company is currently undervalued. But of course, a company having a high PE ratio doesn't necessarily mean that they're overvalued, as there might be other factors to it, and a company having a low PE ratio doesn't mean that they're a good bargain either. But of course, adding this to our other list of steps in analysis will definitely help us make a clearer decision. Now, all these analyses don't even matter if you don't have a particular stock that you want to analyze. So I recommend that you watch this video to know exactly how to get started on narrowing down your options before you start analyzing these stocks.